I'm Andrew Humphries.
And I'm Tom Salmon.
And we're the co-founders of a business called The Bakery, based here in London, but also with offices in Sao Paulo and with people around the world. And we've been doing innovation with corporates and startups around the world for the last 8 years now.
Yeah, and we're going to talk today a little bit about how to manage risk in innovation. It's one of our favorite subjects, about talking about failure and risk, which in the corporate world, it can be a difficult subject. And we have a set of beliefs and mantras, and one of our pillars is this idea of making lots of small bets, which we're going to tell you about.
Yeah, so we're going to go ahead and share our screen now. I think what we're going to do is try and make this as interactive as possible. Just talk for 20, 25 minutes and then open it up for any questions and any discussion that you guys might want to have. But feel free to ask any questions, stick them in the chat, as Adi said. And if there's something that's specific or very relevant to a particular topic, we can take that as we go. So let's dive straight in.
Great. So oh, hang on, my screen isn't moving. There we go. So, make lots of small bets. Again, it's an interesting way of framing this because betting sounds inherently risky, and innovation shouldn't and isn't really a game of chance. It's really about how do you venture into the unknown and how do you manage the risk of doing that. There's lots of unknowns in innovation. You don't know where technology is going and you don't know how necessarily to get to success, and that makes it feel risky in organizations. And this also brings in the F word, which is failure, and that is something that is difficult to deal with. Whoever you are, whether you're a big corporate or not, when things don't work, that brings a set of challenges to it, but it is a really critical, important component of achieving success is to sometimes fail. So how do you understand the risks associated? How do you manage them better, particularly in an environment, corporates, where they're quite allergic to risk for reasons that we'll talk about in a minute. In the startup world, with early stage startups, particularly with technology, they really embrace risk. That's where the area that they're playing in is. They have this asymmetric risk profile. And what we mean by asymmetric is that, there's relatively small downside, but a relatively or very big upside, a disproportionately large upside. They start early, they haven't put too much in, they haven't committed too much time or resources. So there's not so much that they can lose. But when you really look at what a startup is doing, where some people get together and commit time and resources, they're really making a big bet themselves on, what the outcomes might be for this startup. And the chances of any one particular startup being successful are actually relatively small. And if you're a youngish person, maybe out of college, and you start a new business, again, there's much less downside because you're not giving up too much to do that. But later on in your career, you may be giving up a job that's well paid. You and your co-founders may be committing, a couple of years of very little salary, and there is opportunity cost to that, and there is risk associated with it. And the chances of you succeeding are relatively low. But obviously, if you are successful, the returns can be huge. So this is why people do it, but it's also why people are fearful of doing it. When investors think about risk, again, they really love the upside of risk. There's huge potential. They make their gains from the risk. But if they've raised a fund with other people's money, they can't lose that money. Again, it's not like taking it down the casino and putting it all on red, but it can feel like that sometimes. So they have to manage that risk. They have to understand the downside and not lose their money, whilst also delivering returns on the upside. And they do this by, really constructing portfolios. They create a thesis of technology areas that they're going to invest in. They look at the market and understand the market. And, they use their intelligence and experience to evaluate where the opportunities are and where they think it's best to place that money. And they then make lots of small bets. And, when we talk about small, it's all proportional to how much money they may have in their funds. So still might be significant amounts, but they're spreading their risk in many startups to start with. And then as certain things work or not, they will double down on the winners. They'll put more money in to help those grow and to become bigger success. And they're always modeling the success. They're reviewing their portfolio. And a lot of funds are looking to get a 3x return on their money over about 10 years, which is about 12% growth a year on the money. But the interesting thing, really, when you look at the portfolio, is where do those returns come from? It's not evenly spread. All the startups do not deliver you a nice even 12% a year per annum growth. It's not like putting it into a bank account where you know what the returns are going to be, although there's obviously no returns in bank accounts at the moment. But, it's not an evenly spread thing. And as the chart on the right of the screen shows, 50% of those startups effectively are going to fail. They're not going to return even the money that has been invested in them. And obviously that's problematic, but it's really important. The failure component of it is actually an important component of it. The 35% will deliver roughly what you've put in. Well, that's okay. You've got some money back, but actually there's no growth in there.
You're still losing.
It's still effectively losing, really. There's opportunity cost of that money. And then the top 5%, that's 1 in 20, deliver all the returns, really. So out of a portfolio of 20 companies, one business really is going to deliver all of the returns to that fund. And, at the end, you probably say, well, why don't we put all of our money into that one? Why wasn't all our money in that one? Why do we bother with the other 19? But the 19 are really important because when you start, you don't know. You're using, as we said, your best guess, intelligence, evaluating it, looking at the market, looking at the entrepreneurs involved, all those abilities that investors have to assess the opportunity. Even then, the real returns, the big returns, are coming from a very small number.
And don't believe anything they say, because the reality is at the start they definitely have no idea which of the 20 in their portfolio are going to be the most successful. Okay, you can do due diligence, and you should, of course, do all of that stuff. But often the ones that do win are counterintuitive. If we think of and there's so many examples, but if you think of Airbnb, lots of very, highly qualified investors turned that one down because it looked like, a bunch of students doing a studenty type thing. And yet there it is. It's a counterintuitive thing that's turned into a complete unicorn, obviously.
And a very disruptive business to the existing ways of, renting a place to stay somewhere around the world. It's created a whole nother avenue and a competitive threat potentially for, existing chains and hotels. So, again, these things that look crazy to start with, make no sense, can be extremely disruptive. They can look like small opportunities, but they can grow into very big ones.
Absolutely.
And that really leads to here, which is, again, corporates don't like risk. And that's, it's really understandable. It's not there's anything wrong with that. A well-managed company is designed to take out the risk. This is talked about a lot in books like The Innovator's Dilemma, where, as companies grow, you need to manage that risk because you're protecting your downside and you're protecting your existing business and infrastructure. So, you have, lots of staff, you have offices, you have manufacturing, you have distribution, all of those things, and you have to support them. And it's one of the reasons that obviously lead to corporates and big companies being susceptible to disruption, because they have that infrastructure, those commitments. They can't just divest themselves of those and say, well, we're just going to become an Airbnb type business. This again happened a lot in the music industry, where they were built around, a manufacturing and distribution model of physical records and CDs. When downloads came along, they spent a long time trying to continue supporting their existing factories, distribution channels, and ways they had of making money. So it's really understandable why corporates don't like risk and why they are built to manage the risk out. But it's really important to be able to embrace risk. And, the good news is that corporates do risky things already. There are things that are built into the processes of corporates that are actually really about how they manage risk. It's just not thought about like that. And a good example of this is the way that sales works. When you start selling a product, you've got no idea necessarily of what that model will look like. How many leads do we need to get? What's the price that a customer will pay? How many will convert? Whether this is an in-person consultative sales thing or whether it's a SaaS product on a website that's got a funnel, really you're designing and building those pipelines and sales funnels all the time, and you're adapting and tweaking them as you get results. You're starting to learn that we need 100 leads in the top of the funnel to get one sale. And, it seems funny that in innovation, sometimes people want to do one really big thing that will be guaranteed to be successful, but you would never think about sales like that. You would never say, well, let's just go and find one lead that will give us a £10 million opportunity, and we don't need any others. That obviously makes no sense. You might need 100 leads to get the £10 million opportunity, or 10 leads or 1,000, but you need to model that in the market that you're in.
And there are so many things like this that happen in the corporate world that we don't think of as risky, but that have this same kind of profile. If you're an oil company and you're drilling for oil, you don't just sink one big hole in the ground and hope that there'll be oil at the end of it. Yeah, you use your expertise and your planning, and you do geological surveys and what have you, but you sink a bunch of holes, and on the basis of that, and each hole costs a certain amount of money, and on the basis of that, you hope to get one strike. If you're creating products, you have a portfolio of products that you might create, and that some of them are going to succeed, and some of them might fail, or they might not perform as well as others. But that is accepted, and it's in a completely understood way of corporates doing business. And it's not seen as risky, it's seen as how the world works. And in a way, innovation should be looked at in exactly the same way. And that's the key to getting buy-in across your audience.
Yeah, and I think it's dealing with the unknowns. How do you know what's going to work? And sometimes, again, in these environments, you want certainty. We want to know that this thing's going to absolutely work. Well, you can never answer all those questions up front. You can try and manage the risk out, as investors do. Investors wouldn't invest in the other 19 if they knew what the outcome was going to be. But the only way to find the one is to invest in the other 19 as well. And you can't just selectively choose up front. If you had to, choose out of that 20 that investors invest in, you would get it wrong 19 times. So it's really important to, again, model things, look at the goals and metrics and continually review them, and, think about how investors approach this, how sales processes work. And, that's some of the things that we do with people. We help them design the right ways of managing their innovation processes and pipelines to get them to the results. And this is it's a simplified example. This is obviously not the full picture, and we'll talk a little bit more about some of the other dimensions, really, of this innovation process and pipeline in a minute. But broadly, an innovation pipeline looks a bit like this. It's a funnel. You put opportunities in the top, and you filter them based upon a set of criteria that you predefine. You understand the types of technologies or opportunities that you're looking at. You know what you want to get to in terms of success, and you put some criteria at each of these stages to move the right ones through and disqualify the wrong ones. Again, it's really important that you are, failing. You're getting rid of the ones that aren't right. You are backing the ones that do a little bit and then doubling down on the winners. So as you move through this, you start with lots of opportunities, you filter into potential solutions, you do some testing and trials that are very focused on measurable results, and the ones that are starting to deliver the results, you back more and start scaling them. And the scaling process is not a one hit and done thing. It's an ongoing process to grow and, build over time. And not all of those scaling solutions necessarily will achieve complete success. But again, this is about de-risking. You put small amounts of money on lots of different things and double down on the winners, which is how we like to think about making lots of small bets and increasing the chance of outcome by doing more earlier, failing more, learning more, and then growing the winners.
And just like a sales pipeline, the criteria for success are pretty well defined these days, but you need to tweak these for your own environment. So, in a sales pipeline, you would, qualify a prospect, you try and make sure you're speaking to the budget holder, you're, making sure that you're submitting a proposal, that the connection between your business and their business is correct, or whatever it happens to be. In an innovation pipeline, the criteria for success is not, just the fact that the managing director thinks this is a good idea. It's about, is this a valuable opportunity? Is there a bunch of stakeholders built in? Do you have the understanding of the problem that you're trying to solve? Are you solving a real problem for a real, stakeholder? All of those different criteria are really important as to the chances of success of a given opportunity. And we've built a whole map, if you like, of what those criteria should be. We can share that information with you guys later.
So we thought it'd be interesting to show you some actual numbers on this, mapped onto this process pipeline. And this actually represents the last 2 years of briefs, programs, projects that we've worked on. And, as you can see at the start, there were 149 client challenges. And in order to start working on those, we looked at nearly 8,000 potential solutions. It's a lot. There's a lot of companies and solutions reviewed. But, most of those, as you can see, didn't make it to the next stage. That's less than a quarter actually even got to the next stage, to meeting and exploring further. So approximately 1,500 then had actual meetings with us and with the client. And out of that, again, about a tenth of those then progress into a form of trial. And the way that we run trials, we talk about the smallest first steps. We try and do the smallest thing we possibly can initially to start the corporate and the startup, as it is in this case, working together, but with the smallest measurable things that we can start doing to start moving towards success. So we do 178 trials, and out of that, roughly 50% will become scaling solutions. So as you can see from that pipeline, there are some metrics there. Again, this is from across the board of a number of different types of clients, technologies, projects. So, it will be different for all kinds of different companies. How many challenges do you want to put in the top of the funnel? How much do you want to get out the back? What does a scaling solution look like? And what does it want to deliver to the business? And that may have, a number of different things and mean different things to different organizations. It may be, we recently started work with a client. They want to deliver 50 million pounds a year of incremental revenue on their existing services. Okay, we need to design a program that will deliver on that. That's the overarching aim and objective. What do we need to do over a period of time to start delivering on that? How long will it take to get us to 50 million pounds a year? It's not going to happen in year one. it's going to happen maybe in year 3. So, we need to build a model, a pipeline, and a way of understanding their existing business, the opportunities that they can address, the problems they can solve, the number of technologies that might break down. Is it one technology that's going to deliver 50 million, or is it 10 that are going to deliver 5 million each? So, that's a really important thing to think about. What does this mean? And also, therefore, what do you need to spend? And we, again, have modeled this, and I think this is really interesting, that when you look at this in terms of return on innovation spend, which again is analogous to this metric that you have in marketing called ROAS, which is return on advertising spend. What's your return on innovation spend? How much have you spent and what do you get out the back of it? Really, really important to think about that and understand it. If you want to get to 50 million in incremental revenue, what do you need to spend initially? What do you need to invest in these companies to get there? Again, like the portfolio of the investors, they are modeling a 3x return on investment. Well, how can you think about that for your business? What do you want to put in and what's realistic to get out? And how do you track and measure that over time? And we've seen, again, across this very broad range of different types of projects, around a 5 to 10x spread of return. And it really depends, because some obviously deliver huge amounts and some are quite disruptive with lots of revenue, and some actually have much smaller initial investment and much more incremental, but with a potentially smaller return, but still extremely valuable.
It's quite surprising when we talk to corporates that many organizations, whilst they have a structured innovation process or a program, they don't really know what their metrics are. And they don't really know what the right numbers for their sector or for their scale would be appropriate. This information is very difficult, to come across. And actually, there's not a huge amount of research and data around what these metrics should be. What we're showing you here is what our experience is across, sort of a few years. I think this is 2 years of client challenges. And the kind of returns that we've been able to map. A lot of people, because of the failure word and because of the fact that they're not perhaps getting the success that they'd like out of their innovation programs, actually don't reveal these numbers and often don't even measure them. So it's really important when you're trying to create an innovation strategy for your organization that you try and think about what the right numbers are for your business and what you're looking to achieve, and also what you're looking to put in for what you want to get out.
Yeah, it's a critical thing. You can't, again, often there's a budget or some idea, but no idea of what you want to get from that. And again, I think this can be very detrimental, because it's easy to spend money in innovation and not deliver return. And the same with advertising. You can very quickly spend money on advertising and deliver no return. You need to understand where the return is coming from. You initially, it sometimes feels like you're wasting money with advertising. You don't know what's going to work, and you have to spend it to find out if it does or if it doesn't, or where does it, what is the return it's delivering, and start modeling it. So similar in innovation, you need to spend some money, but you need to measure it and be working towards some goals and outcomes, and, continually tracking and refining. If you're not getting the returns, why is that? Is that because you're looking at the wrong opportunities? Are the selection criteria at the stage is wrong? Is there a problem with other internal components of the business that, that are blocking the right innovations coming through? Again, we've seen this with, internal other teams in other departments of the business who often might block innovation because it doesn't look certain enough. So again, it's really important to engage those other stakeholders and make sure that everyone understands what we're doing here and why, and that this failure component might happen, but we are tracking and measuring, and we're spending money very efficiently through this process. So, as a little summary, we believe you should make lots of small bets. And just the diagram, the picture on the right shows it's about actually getting chips on lots of the board. It's not about placing it all on black or all on the number 23. It's about spreading that risk initially to deliver your return. So think about how you can build a portfolio, how you can model that, as we've shown. We're going to talk a little example in a minute, which will show you some other dimensions to this. But what are the goals and outcomes you want to achieve? How much money do you want to return or make? Is it incremental? Is it disruptive? What are the types of innovation you're doing? What are the time horizons? Again, it's a really fascinating whole area in itself. Are you talking weeks? Are you talking months? Are you talking years? Again, there's big innovation that can take years. There's small, quick things that can deliver quickly, relatively quickly. There's things that you can do in weeks or months. So, the time horizons of things that you want to tackle, the impact that will have on the business over time, and onboarding the organization, unblocking those things, making sure that everyone understands the people that will need to sign some of these things off. They may be in the finance department. There may be ways that the company has defined that they work, margin that they need to make, or things that might not look like they quite work with some of these new innovation things. So how can you make sure, A, that you know those things early enough that, the finance team are going to look at it this way, and that, A, you can either bring them on the journey with you. That's a really great way of doing this, is make sure they're really vested from day one. They understand what we're doing. They're not suddenly brought in at the 11th hour to see something that they go, whoa, hang on, this doesn't fit with our model. So bring them in early, make them part of the journey. The business model innovation component, it's not just necessarily about a technology or a product or a service. It's about the business model, the finances, all those other elements in the business that, are critically important, that will, be needed to be on board for this to be successful. So onboarding the organization, getting them in the room, bringing them on the journey, and understanding how they will evaluate this is really critical.
So what we thought in the last 60 seconds, we'd just share a sort of very quick case study. This is a very large organization called Natura & Co. You may know some of the brands. In fact, you should know some of the brands. They own Avon Cosmetics. They own Natura, the cosmetics brand. They own the Body Shop. They recently bought the Body Shop a couple of years ago. And they own Aesop. So these are 4 very different brands, very individual companies, actually, have been brought into a group by primarily by acquisition. And they had a bunch of objectives that they wanted to achieve in terms of innovation across these 4 brands. They wanted to, create a real center of excellence, so that everyone that had innovation in their title, no matter which brand or which department they work for, could access this understanding of how to innovate within the organization. They also had a goal to intensify their global thinking, in terms of not just thinking locally. They wanted to really make sure that they were thinking in a global way. They really wanted to create a series of what they call products, a product stack in innovation that enabled them to attack any different type of innovation opportunity. And they wanted to create Natura & Co. as a real destination, an understanding that people around the world, entrepreneurs, startups, but other innovators, it was like a magnet for innovation. So this is really their 4 key goals. And what we did as a business is worked collaboratively with their innovation team to, first of all, understand their strategy, look at what they were looking to do, and also look at other strategies around the world in similar and different corporations that were working, then design a really unique approach to innovation for Natura & Co. that delivered on the objectives that they had, and then finally, obviously, to implement that approach. And we, along with their innovation team, have created a unique 4-hour, 4-day, 4-week, 4-month process for any type of innovation opportunity around the business. Any stakeholder, any business owner, any divisional head could go to the central innovation hub, and they've created a brand. You can see they're very, obviously very environmentally conscious and friendly business. So they've created a set of brands called Oxygen, Ocean, Founders and Ventures, and a whole process flow depending on the type of opportunity that a stakeholder might have. Is this a problem that you want to solve? Is this an opportunity you want to take advantage of? And then a process flow and different methodologies to address that innovation problem or that innovation opportunity with gates along the way to make sure that they were fitting the criteria. And so therefore they were building a whole service, if you like, for the whole business. And it's a really interesting approach, very unique approach that allows them to cover multiple time horizons, partner, build, and also invest in opportunities, but also to deliver a clear set of metrics and goals and make sure that they're delivering financially for the business. So putting a real return back into the business from innovation. And I think this is a good study that large corporations can create innovation centers that work and deliver for the business in terms of not just delivering innovation, but delivering returns, financial returns, commercial returns to the business. So I guess that's where we want to stop talking now and hear your views and answer any of your questions and also get your insight into how you guys are sort of measuring your returns and what kind of returns you're getting. If you're happy to share that, it'd be great.
Yeah, how does this idea resonate with you? What have you learned? If you don't agree with it, that would also be great to hear.
Sure. So I want to thank you. It's been really fascinating. And I'll just go through what people have said. And if somebody wants, I'll ask you if you want to say it instead of me reading it. So first, Klaus really liked your analogy on sales. And then Nicolas says, hi, Ofer. Hi, Ofer. I know Ofer. Do you want to ask the question or you want me to read it?
Yeah, I can ask that. So basically, one of the challenges is when you measure, like, what are the metrics? Like, obviously, return on dollar for dollar or pound for pound. That's easy, but it's air quotes easy because the money or the actual return may be 1, 3, 5 years out.
Yeah.
So how do you measure that interim process? The second part is a lot of times the return is not directly in revenue or savings, but it's learning, or it's let's call it soft revenue or soft. So I'll be happy to get your thoughts on how do you, like, the hard metrics, like really, how do you measure, what are the KPIs?
So this is I love the way you framed that question, because we believe in learnings, and actually we often use this quote, which is sometimes you win and sometimes you learn, which is great. But really, when you're learning, in our view, you're learning, but you're really failing. The thing has failed, and that's fine. It's not a problem. A success in our terms, and frankly, we're super commercial about it. If people aren't seeing a return on their investment spend, they don't keep using us. So it's really important for us to be able to prove a financial return. And I would argue that for every innovation person within any corporation, they should really be trying to understand what their commercial return is for the business. So whilst I agree with you, there are soft returns. The real things that are important are the hard returns. And if you can't measure those, then I think you've got a problem. So I think it's really important. But the other thing that you mentioned is absolutely right. The time of that return, can be variable. Just like in an investment portfolio, you need to understand when you're going to try and get those returns. And part of the portfolio element is there are some short-term quick win innovations that you can do, which could drive returns within a 12-month period. And so, it's rare to get innovation returns in the financial year because, that's quite hard. But certainly within a 12-month period, you should be able to be seeing actual commercial returns on some of your investment portfolio, of your innovation portfolio. Some of your innovation portfolio will definitely be 18 months, 2 years, 3 years, even 5 years out before they're showing you return. But you can, because the idea is you build this portfolio, that shouldn't matter. And you should be able to fund your innovation from the returns that you get. And it's really interesting because when you start thinking about it in those terms, it becomes much easier to get the finance department to fund you.
So I'll just add to what you're saying. So I think one of the challenges, and it really depends what kind of innovation you're applying, like what target market. I mean, if you're going, hard revenue, that's easy. You just say, what are the sales, what are the margins? If you're talking about more internal disruption, automation, that's where you need to be. It's a gray area about how you measure savings. Like, oh, we saved this and that. Like, did it actually change the bottom line? I mean, that's where you always, as an innovation, executive, you try to push for hard numbers, but you don't want to push. But sometimes you don't want to push too hard, right? It's just
it's hard to get, and I get that, but I think it is important to try and do it.
And to agree, for example, we did a thing with a financial services organization with an AI engine, and what we modeled and agreed with them that if this succeeded, it would save X amount of somebody's time a week, and we put a value on that because we knew it wasn't actually revenue in and of itself, but it would be a saving of time, and that was a quantifiable output metric. I think that the learning thing is difficult to put numbers on, and obviously if you're a commercial organization, unless you're doing it as a research piece, specifically the outcome is learning, and if you define that as the outcome, that's fine, but learning should be part of the feedback loop that's going to improve the future profitability of other things that you do. So if you do 10 things, 9 of them fail, 1 of them works, but the other 9 have informed how successful you are, then that's great, and they all it's a feedback loop into future success. It's you rarely are going to do this purely for learning. Learning is really critically important, but it's what do you do with that, and how do you put it back into the system and get better? So if it's failed, why has it failed? What did we learn? What are we going to do better or differently next time? How do we make this work better? So it's a great thing, because again, there are all these unquantifiable, unmeasurable, there's a huge, some of the work that we do, there's a huge cultural impact in an organization, changes how people think about the things that they can do and the ways that they can work. Quite difficult to measure that, really. It's a very important component of it and a sort of byproduct, but again, it's difficult to put a hard and fast number on it. But again, it is a really important component of it.
Yeah.
It's important to measure everything, but you need the hard numbers.
You definitely need the hard numbers. And
no, but I don't want to derail. I do want us to.
You're absolutely.
There's other questions, but this is fascinating. Thanks, guys.
It's one of the reasons we like to talk about it, because so many people shy away from it, and it's a key element of this. Thank you.
Thanks, Sophie, for the question. Klaus, do you want to ask the question? Is it related to internal innovation and a collaboration with startups and the comparison between the two? Sure,
happy to. I guess, first of all, thanks for the great flow. I like the story. And I relate this primarily to the way corporates innovate organically, so internally by setting up teams, units internally. And then you look at this more like a VC, right? You just need to provide the right funds, and you need to provide the right steering mechanisms to find out which of the investments become serious ones and which ones need to be discontinued quickly again. But you might also apply the same, and I was expecting some of this in your presentation, given the abstract. You might apply the same also to working with external startups. Even though in those cases you might pick the winners already, right? You might pick only startups who are already in Series A, B, C funding, who already have customers, and then you work with them as a corporate, and you can then more easily de-risk your investment.
Klaus, you're absolutely right. And we believe that exactly the same thing. And if that didn't come over, the reality is probably 60% of what we do is work with external startups, but the same principles apply, because even though you're quite right, even though they may have had some funding from who knows which investor, that doesn't necessarily mean that they're going to be able to work with your corporation, your business, your stakeholders, or solve your particular problem. So by spreading your bets, by having a portfolio of startups, and by having a portfolio of innovation opportunities that you're working on with those startups, you increase your chance of success, you decrease your risk. And I think it's really important to apply these principles across every type of innovation, whether it's partnering, whether it's building new technology internally, or whether it's investing in external opportunities.
Or acquiring, same thing.
Absolutely.
Also risky.
Completely.
Yeah, and again, I think it depends on which aspects of the business, again, on that risk curve and technology adoption, those things fall. Obviously, at one time, evaluating a video conferencing platform might have been seen as an innovation, whereas now it's a purchasing decision, which one do we use? And actually it then whittles down to very few. But again, is it a core component of your business? Does it affect the thing? And is it, what is the risk profile? Is it a knowing thing that we're just buying, or is it we're trying something because we think it will work, but there's some degree of chance of it not and failure? So that's where true innovation R&D comes in, I think.
Thanks, Klaus.
Yeah, thanks.
Yeah, thank you
for taking time to be give us the feedback. Alex, do you want to share your thoughts?
Yeah, I think it's actually building a little bit on top of what you just said right now. So I work in the financial industry for a banking group. We have quite a few banks in our network, and what I'm observing is, because I always try, banks work on return on investment. That's like our basic logic. We have been prioritizing projects like that for as long as we live, and optimizing risk is kind of also part of our DNA. But what I see is, especially for the high risk, high return projects, so what I call the horizon 3, or more that have a more disruptive nature, which I kind of intuitively think we should now definitely start tackling them, because it might get too late if we don't. There I find these metrics a little bit more difficult. And I wonder, do you use some type of proxy metrics to the eventual ROI, or how exactly do you track projects, or not projects, actually on a funnel level? How do you track, and what do you look at for let's say, topic areas that might have an ROI in 10 years, right? So that's that's where I'm coming from.
I mean, I think one of the things that we do, I mean, Andrew may contradict me, but one of the things that we do with this is that we whilst we do these trials, and we call them the smallest first steps, we try and map what is the biggest, hardest goal. We try and have this big, what does this look like in the future? If it's a 10-year time horizon, what would the effect of this be on our business? How much would it be worth? And what do we want to achieve? And we try and vision that with the right people in the business. Is this going to be, 5 million, 10 million, 100 million? And, how long might it take to get there? So painting that picture, understanding the realities of that are really critically important as a guiding light. But obviously then, once we've done that biggest, hardest goal mapping, we then try and rewind it to the smallest first step. What's the smallest possible thing that we can do to incrementally, over this long time horizon, getting there? Because we're not going to get there in one step. As you say, it's a long way out, lots of risk and uncertainty in long time horizon things, but lots of opportunity and lots of need for the business to address those, because like you said, if you leave it too long, it might be too late. So, but we then try and take it into small steps to start testing, trialing and de-risking that big thing, because the bigger it is, the longer the time horizon, the more risk is involved. If you take it in small steps and work towards it, you've got much more chance of getting there. But yeah,
I couldn't agree more. I think one of the things we talked about, the the criteria for making sure that something progresses along its pipeline. And one of those things is definitely, can we really see where this could be, and what are the obstacles to that? Can we understand that and mitigate that? It's really interesting because within a large corporation, and by the way, just because you're in the financial sector, it doesn't mean this is a problem that only occurs in the financial sector. We were talking to a big beverage company who, for example, something that doesn't turn over $1 billion for them is irrelevant. So how do you take something that is really tiny and small and looks insignificant, but keep investing in it because it may be $1 billion business later on? And that's a really hard thing to try and map out, but you've got to try and map it out. And if you can't see that, then it's probably one that you shouldn't focus on, and try and find one that you can focus on. Just like a sales pipeline or any of the other pipelines we were talking about, you've got to have this filtering process that stops you working on the things that you can't see, but encourages you to work on the ones that do have a chance of success. And again, the only thing that allows you to achieve that is to have a significant number of the things coming in at the beginning. If you don't have enough, you're only working on one thing, the likelihood of it succeeding is super low. So, it's about having this portfolio approach of these big potential things that could succeed, and knowing that only likelihood one or two of them will.
If I may just share something, because I think this is a huge, massive, also cultural challenge. I see this with our innovation board. They're like, okay, why are we talking even about this? It's a few K, right? Why are we even talking about this? And they're not understanding the expected return, and then they're also not understanding why this requires their attention. Sometimes, not all of them, the different maturity levels on the board as well. But I find that quite impressive, and I'm always provocatively telling them, actually, our biggest problem is that we have too much money because we do not do the small bets. We do the really big ones, like we can afford to lose them, right? So I'm sorry, but I don't want to hijack and leave some space for other people's questions. But I think this is rather even a cultural challenge, not only about metrics and process and design.
It's a super common problem, and it's one of the things why we say that in order for you to achieve this sort of approach that we're talking about, you really need to onboard those people as part of this process, get them brought into this approach. And it's interesting that they completely accept it in many other areas of business, but not in innovation. And I don't quite get it. So, and
I think that, there's this, I think, in startup and investor world, there's sort of this post-rationalization survivorship bias where everyone forgets about all the things that didn't work to get to the ones that did. And then they just go, well, there's one big Uber, there's one big Google, there's one big eBay. But that's forgetting all the other people that tried to build search engines, all the other people that tried, they didn't, and all the other investments that were made around that. And that if you are a big corporate, yes, you may want to build another $1 billion brand or unit of your business, but in order to do that, you need to start A, small, and B, by trialing a number of different things, because you can't see that far into the future and you can't know what is going to work. So, again, the bigger it is, the riskier it is. The only way to get there is to try lots of things and start very small. And, but I think that people think it's a big opportunity, a big idea, so we need to choose one now today and make the perfect decision. And it's not possible to do that. You just can't, even the smartest, you could be, I don't know, Warren Buffett or the smartest man in the world, whoever that might be. And, Elon Musk or someone, or, with the best will, you cannot there's a degree of guessing.
Yeah. So we're almost done. And Christina said that she completely agrees with the cultural problem. And I could say it's not only a cultural problem. I see like Israel is very innovative, and still the board members are usually more conservative. They take care of the money of the stakeholders and that they get the revenues that they expect. And most of them are more a traditional way of thinking, and it's not only where is the company is located. Nicholas it will be our last one because we want to have like an option to take coffee and go to the bathroom between the discussion. So Nicholas, do you want me to read or you want to ask? So I'll ask. We measure quantitative impact, new customers, transaction revenues, as well as qualitative NPS of the service, brand perception, customer experience. This is what they measure. Does it make sense to you too?
Oh, absolutely. And again, coming back to the case study, the example that we showed, a key metric was how do other people view, our innovation activity? Are we delivering a valuable service to stakeholders around the business? All of those things are absolutely important to measure. There's no question about that.
I mean, if it's something that's going to improve your customer experience and your output is to improve your NPS, then that's a great metric. It may be the measurable thing rather than the revenue piece. So, I mean, 100% those metrics are all fantastic.
I think the key thing is to know what your metrics are. So again, so many corporations struggle. They just say, well, we just need to do some innovation. Let's get it going without having thought about it beforehand. And I think the key here is just to put a little bit of thought into it and understand what would work for you, what good looks like for you.
Yeah. So I want to thank you for your time, Tom and Andrew. It's been really fascinating. And I want to thank everyone here for taking part and engaging. And I wish us all a really great afternoon, morning, evening, wherever you are.
And could I just add, if anyone wants to get in touch with us, we'd love to hear from you. My email's tom@thebakery.com. The deck, I think, will be distributed and the recording maybe. But, if you want to talk about this anymore, run anything by us that you're doing, it would be great to chat. So just please get in touch. And we'll speak again. Thank you.
Thanks for all of you.
Will you share the presentations afterwards so people could see?
Yeah, we'd love to.
Sure. So thank you again. Have a great day. See ya.
Bye.
Bye-bye.